In Assignment 7, we begin to look at some information that is provided in the financial statements outside of the four basic statements. Remember from your accounting 1 and maybe intermediate classes that companies are required to disclose any information that might change the potential investor's decision regarding investing in the company. And the way the companies do this is through notes to the financial statements, additional information that explains some of the accounts that are included in the financial statements. Now, in this assignment, we will look at two of the major accounts in most companies, accounts receivable and inventories, with a little detail. I'll also ask you how the company presents cash, and that is a little bit different in that what most companies do nowadays is report cash as cash and cash equivalents. So you need to go back and remember that from probably your intermediate accounting class, that cash equivalents are those items that are nearly cash. In other words, they can be converted immediately to cash, generally within 90 days of the balance sheet. So therefore, companies include them in cash in their financial statements. Now, as I said, most of this information for this assignment will be found outside of the basic financial statements, so you'll need to do a little digging to get the information. Now, one of the primary places to look for the data for this is in accounting policies. That's where the company tells you what their policies are relating to how they do the, quote, for lack of a better word, bookkeeping that's related to the accounts included in the financial statements. So I'd begin my search there and then look for additional footnotes that might help explain what's going on within the accounts. Now, the first item we're going to look at is accounts receivable. Here, what we're going to do is what's the allowance as a percentage of accounts receivable, what's bad debt expense as a percent of revenue, and these are percentages that you like to see in companies that have substantial accounts receivable. Now, not all companies will disclose bad debt expense because they take the position that's immaterial to the financial statements as a whole. So don't take the fact that one company discloses bad debt expense and another one doesn't as a sign that they're trying to hide something. It's just that, in the opinion of management, the financial bad debt expense is not significant and doesn't need to be separately disclosed. The other item that we'll look at in this case is inventories. Now, inventories, again, go back and remember, this company is a manufacturing company, so therefore they're going to have all three classifications of inventory: raw materials, work in process, and finished goods. Those amounts need to be disclosed within the financial statements. However, they don't have to be disclosed on the face of the balance sheet. So you'll need to, again, look in the footnotes to determine what the detailed makeup of inventories is. Again, in this case, we're going to compute some percentages. In other words, what percent of the inventory is to total assets. What's the cost of goods sold percentage. And then inventory turnover and number of days sales in inventory. So the worksheet's set up to do all those calculations for you. All you do need to do is find the amounts that are included in the financial statements to make those computations. Now, the other thing that we have here is a Word document where we're going to ask some questions, and you'll give me some comments relating to these accounts. We're going to look at accounts receivable turnover. Now, remember, turnover talks about how fast we collect accounts. So therefore, when you look at this, if it goes up or down, what does that mean to the company? Are they collecting their receivables faster? Are they collecting them slower? What's the impact on cash flow of the changes in the accounts receivable turnover? So look at those things from a standpoint of understanding what turnover means in general terms, and then what it means specifically to this company based upon the ratios that you calculated. For inventories, as I said, we're going to look at uh, the major classifications. What are they? How are they accounted for? Again, that's going to be outside of the basic financial statements. So you'll need to find that in the footnote. The second question that relates to how does the company account for inventories? Now, here we're looking for, do they use LIFO, FIFO, average costing? And again, you're not going to find that on the face of the balance sheet. You're going to need to find that in a footnote on inventories. Now, in intermediate, you probably were exposed to how we account for LIFO inventories. In other words, first in, first out, FIFO, is what we generally find in financial statements. When companies use LIFO, last in, first out, there is a difference between LIFO and FIFO that we call the LIFO reserve. In other words, that's the amount in total that brings inventories from LIFO up to what they would have been had the company used FIFO reporting in their financial statements. Now, there's a place in the assignment to determine what that amount is if the company is using LIFO versus FIFO in their financial reporting. Again, in this case, we're going to compute inventory turnover. The same comments are true. Inventory turnover means how quickly do we sell finished inventory. And so we want to look at how that has changed from year to year. Again, what are the implications to the company if the inventory amount, or inventory turnover, increases or decreases? So again, understand what turnover means and then apply it specifically to this company to answer these questions. As usual, if you have any questions regarding this assignment, please feel free to contact me.